Hello and welcome to the Strategy of the Week for the 19th of April. My name is Angel Clark, Director of International Sales. This week's strategy is about a fairly unpopular subject, selling. In fact, Chapter 10 of the book Stock Strategies and Common Sense sums it up nicely. Selling is a crucial part of successful investing, yet it is avoided like the plague. The reasons are clear. Buying a stock is a fun, positive event. It's the beginning of a hopeful relationship. Selling is a negative experience, the end of the relationship. Hope of future profits is gone, and losses become reality. Tax consequences must be addressed, and the proceeds need to be redeployed. Selling is not fun, but it must be done. If you haven't read that book yet, I highly recommend you check it out. It actually came with your trial package, and while it will help you gain a greater understanding of VectorVest, of course, more importantly, it will help you gain a greater understanding of the market. This particular chapter was referring to stop prices on individual shares. But as hard as selling an individual share is, selling all your shares when the market turns down is absolute mental torture. And it's not always necessary, right? Sometimes corrections in the market are mild and your shares are strong enough to sail right through. So wouldn't it be just as good, maybe even better, to wait until your shares have actually met their stop loss to sell them, even though VectorVest is signaling a market downturn? Well, on one hand, you don't know how bad the downturn will be, and by selling, you lock in profits and you stop further losses in their tracks. If you stop your losses soon enough, you'll have more money to invest in the next upturn, helping you compound your gains faster. On the other hand, though, if the downturn isn't bad, but you still close out of your shares, you might have to buy your shares back at a higher price, you'll have to pay more commissions, and you'll need to deal with those tax consequences. Which one falls into your comfort zone? It should probably be the one that helps you make the most amount of money with the least amount of risk. So let's find out which method that is in this week's Strategy of the Week, the comfort zone, maximizing profits and minimizing risks. As with all the strategies we demonstrate, the combination of market timing system, share search, and stop loss all work together to achieve the results. And for this strategy, I chose a new search that has just been added to the system over the last month or so. It's called CI Up and Comers. CI is VectorVest's comfort index. When used to rank shares, it finds the shares that have been rising with the most persistence. You find shares that have been hitting new high after new high consistently. But this search doesn't use CI to rank shares. It's trying to find these amazing companies a little bit earlier in their trends. Still waiting until this trend is established, though. The search does this by using the new custom moving average ability of ProTrader. So you do have to have ProTrader in order to see this search. If you don't have ProTrader, though, just give us a call for a free trial. It's a great value, and you're going to be surprised at how often it comes in handy. This search is basically looking for shares that a few weeks ago were at the threshold of crossing CI's 1.0 line. That's where we go from unfavorable to favorable. So 4 weeks ago, it was less than 1. 3 weeks ago, the CI is near 1. And the purpose of using 3 and 4 weeks ago is to give you some time to see what that share has done since. So I definitely encourage you to look at the graphs on this one. That's why it's in the cherry picking group. You can see that over here. In addition to just nearing the CI favorable threshold, the search is also trying to find strengthening CI trends. And it does that by also requiring that the CI be greater than the 10-day moving average of CI, and that the 10-day moving average of CI be greater than the 20-day, and then again bringing us back to finding these stocks fairly early once they've established this trend. The 20-day still has to be hanging out near the 1.0 threshold. Of course, today we're in the middle of a downturn, and if we run this search, we're not going to find anything. But let's go back a little ways. I'm going to use the quick dates and select the GLB RT Kicker timing. Go back to the beginning of this year, January 2nd of 2013. Click OK. We'll run this. Pretty selective, only comes up with 2 stocks, but let's take a look. Those parameters of the 20-day being near the 1.0 threshold, the 10-day moving average of CI being above the 20, and the actual CI being above the 10-day moving average are exactly what helped you find such a nice entry point into a beautiful share like Bega. And as you can see, this share still hasn't been phased by the current downturn that we're in. It's a fairly complex search, but the work's already been done to give you an easy way to identify these potential winners early. And as you can see by this stock, it actually finds the type of shares that have decent odds of surviving downturns. That's why I chose this particular search. Feel free to experiment with others though. For now, we're going to move to the back tester and start our testing. We'll create a new back test. We'll use $25,000 initial investment, $20 commission per trade, no margin. We are set to open and close positions at the next day's open. For our timing, it's going to be that GLB RT kicker, and you can see the rules displayed. Up signals are going to appear when there's a green light in the price column of the color guard, and there's rising momentum using the 5 and 20-day moving averages of relative timing. A down signal is given when we receive a confirmed down call, and neutral signals happen when there's a green light on the price column of the color guard, but it's not confirmed by momentum, or there's just no green light. Next, we'll move on to our search selection, and that's going to be in cherry picking CI up and comers. Remember, you do need ProTrader in order to see that there. Our stop criteria is next, and I'm going to choose a gain loss of 30% gain or 10% loss. And since this is fairly restrictive, I'm also going to uncheck the box that says simulate intraday stops. That means I'm going to base my gain or loss off of the closing price. Hopefully that will help me avoid some whipsaws and eliminate some of the intraday volatility. Also, with only a 10% stop loss, if the downturn does become bad and you're waiting for your stop loss to get triggered before you sell a position, then you should get out pretty quick, right? With not too much damage? Well, we're going to see. We'll move to more settings, and this is going to be a 5-stock portfolio. We'll go ahead and automatically replace closed positions, and we'll try to buy all 5 positions at once. We don't need to close any open positions when an upturn is signaled because we want to use that extinguishing technique. That's what we call only closing positions based on our stop loss. And if we sell a stock, we don't want to turn around and rebuy it right away. So we're also going to apply the 31-day rule and wait at least that long before rebuying the same share. When our timing system signals a down signal, what do we want to do? Well, in extinguishing, we choose no action. That will allow us to only close our positions if the stop loss is met and not pick up anything new during that time. When we have a neutral signal, same thing. And then we want to select our test period. I selected a fairly extensive time, September 6th of 2010 till basically current. And then we'll see the results. Now this period includes both some severe downturns as well as some mild downturns. As you can see, we just went through a more severe one. Compared to what the Australian market has gone through over this same time period, these results aren't too bad. Overall, you've got a 36% gain over the time period. And the worst part is that you had to suffer through a 23% drawdown. That's certainly not the end of the world, but that number represents the biggest loss that you held at any one time. So the smaller it is, the more comfortable you are. Let's see what we get when we take this same portfolio and choose to close positions instead of just listening to our stop criteria. A substantial improvement, not only in the gains, but in our risks. we've managed to cut that drawdown down to 13% from 23%. We've also managed to go from a 36% gain to a 57% gain. Even factoring in the extra commissions, we did a lot better by closing positions instead of trying to hang on through downturns. You might have noticed that there's a couple other tests here. I ran similar tests, but this time using a little less restrictive 20% trailing stop. Really same type of results though. In this case, just to show you the setup, I did use the intraday, simulate intraday, because I was a lot more generous on my stop criteria. And by extinguishing positions, I had a 27% gain during that time, and my drawdown was 26%, almost as much as my gain. There's a look at that chart. Then, same exact test, but closing positions on the downturns. The gain went up to 53%, so nearly double, and the drawdown went down to 16-17%, a much better ratio of risk to reward. And if you're curious, the Australian VectorVest composite during the same time earned about 7%, with a lot of ups and downs. So all of these portfolios substantially outperformed the market. But we wanted to investigate the management technique that would give us the best overall results. And in doing that, there's something I want you to notice. And that's in the short term, you can easily be lulled into a false sense of security. Over the last year, the corrections haven't been that severe in the Australian market, and either of these methods would have worked. So if we're looking, let's say around April here, we've got a nice gain from 17% to 53%. And then from around April on this portfolio, we've gone from just about 1% to almost 27%. So actually very similar gains. And I actually ran those tests and they had similar drawdowns during that period as well, both very, very low. It wasn't until I started running the long-term tests that the difference in risk really showed. No one ever knows how bad a downturn will be, but all it takes is one nasty one to take a healthy portfolio underwater. I'd venture to guess that giving up all your gains, moving into the red, and taking 2 years just to get back to where you were is not in your financial plan. You also want to consider that in this case, getting back to where you were was still a result that we achieved using VectorVest market timing and VectorVest unique indicators in the search. Who knows what would have happened otherwise? You could still be underwater. Can you imagine if that happened when you were ready to retire? The inconvenience of getting back in just doesn't seem to outweigh the risk you take by staying in. This is research though, not advice. Clearly, you're the only one that can make this decision for your portfolio, and you'll be able to factor in your own unique tax consequences, which can always make a difference. Using options, using international markets, or hedging might offer some great alternatives for you. But no matter what your situation is, VectorVest will always provide you with the best tools and market guidance to help you stay in the comfort zone. And that concludes this week's presentation. Thanks so much for joining me, and please visit the university for more great tutorials.